All right, good afternoon, everyone. So today we're going to be talking about return on investment and introduce time value of money. Like I said on the first day of class, that's one of the two most important topics we're going to be talking about in this course. It's something that we're going to be working with throughout the rest of the semester. And it's something that's going to affect your personal financial life throughout the entirety of your life. So we're going to be talking about some really important things for you to consider over the next couple of weeks for your own financial life. A couple of quick announcents. All faculty received a very strongly worded email that we're supposed to leave doors closed throughout the class. I was thinking about getting like the door blocker there, but we're not allowed to do that. There's an internship. This is going to be located in Canada. So if you're interested in a trip, you can put in an application here. I don't remember where this one's located, but my family went to Montreal last summer. It was a great trip. So if you're interested, definitely recommend that. There's a short seminar in investment basics towards the end of this month over Zoom. If you're interested, you can go ahead and attend. I might attend just to see, what people are talking about. But yeah, could be some useful information for you. Also, if you haven't already submitted your attendance, that's due tomorrow. I submitted it already this morning. I extended the deadline to 5 o'clock this afternoon. So if you want to be counted for attendance, which is really important, if you're getting any sort of scholarship or financial aid, you need to be attending your classes. So you go to quizzes, starter term attendance, and just answer that question. Once you answer that question, you've engaged with this class, and I can count you for attendance purposes. Any questions before we get started? All right. So today we are going to start working with Excel. So I will be posting the Excel file when we're done, right? So you just go to our Excel practice, download the sheet, and I'll upload after class the sheet that we've been working on. So you're welcome to go along with me. It will be probably faster than you're used to if you're not used to Excel. So just focus on what I'm doing, or you can go back and watch the video after class. You don't have to bring your computer with you. If that's how you want to work along, though, you're welcome to. All right. So we're basically just going to be talking about calculating returns and introducing time value. All right, so a lot of what we're talking about stems from a basic economic fact that the value of something is what we expect to get from it. Right? So when we buy food, we want to eat that food. Right? That's the reason we purchase food. We intend on consuming it. When we purchase assets, particularly financial assets, we're looking to get a return on our investment. Right? In other words, we're generally looking for more money, or being able to exchange that money for more purchasing of goods and services that we're interested in. Understanding what a return is very integral to finance in general, and particularly in this class. Right? It reflects a growth of investment. It's how we're going to be measuring performance, and it's how we can compare performance across companies and across time. All right, so why are we using returns rather than prices? There's a few reasons for this. First and most important, returns are going to be controlling for the scale of investment. Right? When you say you have a 10% return, all you need to know is how much you initially invested, and that's going to tell you more about the dollar value of your return. If instead I said you got a dollar return, that doesn't mean much unless you also know the starting point of the portfolio. Right? A dollar return on a dollar invested is a great return on investment. A dollar return on $1,000 investment, not so much. All right, so we use returns because it controls for the scale of investment, and they're what reflect performance of assets over time. Right, so in general, and this is something we'll be getting more later on, a price is supposed to reflect the expected discounted future value that an asset is going to be generating over time. So whenever we're looking at returns, that reflects a change or a growth or decline in the expectations of future cash flows. So we use returns because they control for scale and they reflect performance. All right, so this is how we're going to be measuring returns. Basically, it's how much we get for it today minus how much we paid divided by how much we paid. Whenever we see subscripts like this, it's basically going to be a reflection of the time period we're dealing with, right? So it's basically just how we reflect the formula. All right, so in other words, how we're going to be interpreting this, the percent return is going to be the price today that we can sell something for, any payout that we've received. So generally that means dividends or coupons from bonds. And usually we assume that this payout is occurring at the end of the return time period or being reinvested. That just eases this computation quite a lot. Then we subtract from that the price that we initially paid. In other words, how much we invested in the asset, and divide it by the price that we paid. And so you've probably seen this formula at some point already, but it's important that we go over it again to make sure that we're all on the same page with that. Another way to look at returns is the capital gains portion and the yield portion. Right? In other words, when we're looking at the capital gains, so that's going to be the growth in the price of the asset over time. That's a general reflection of the underlying economic value of that asset that you're investing in, or the operating performance of the asset that you're investing in. The dividend yield are just payouts, residual payments, right? Comes from net profits that companies are going to be generating over time. Dividend reflects just how much of the asset is being paid out in a given time to its investors. But again, this is just breaking up algebraically basically what's inside the parentheses in the numerator. All right, we can represent returns as percent or dollar. This is a technicality. We're basically always going to be using percent returns in this class. So whenever I say return, what I'm strictly talking about is percent return. Technically, there is a dollar return as well. So to get the dollar return, we take our initial investment, multiply it by our percent return. That gets us the total dollar return. The cumulative dollar return, it's going to be similar, but we're basically just adding in a 1 to the percent return. Right? So what we're getting is the initial investment that we made plus the dollar return on the investment. That gets us our cumulative return over time. But again, whenever we use the word return, we're talking about really the percent return. All right. We're going to pop over into Excel now and start working on some examples. So I took some stock prices. Keep in mind, I'm not adjusting for dividends being paid out or stock splits. Apple had both dividends and stock splits over the time period between 2016 and 2024. So the return that we're about to calculate is actually a significant underrepresentation of the actual return. All right, so the setup. Bought 100 shares of Apple stock for $26.34, January 4th, 2016. Sold the stock for $225.69 on September 2nd for 2024. Again, we're assuming no dividends or stock splits. That makes this a lot simpler. Things get more complicated when we start including those in. And we're just calculating return at the moment. All right, so the things we need in order to start calculating some information about this, we need the number of shares. Right, so we bought 100 shares of this company. Can anyone remind me, what does PT stand for? P subscript T? Yes, that is how I had it in the PowerPoint. There's a couple different ways to do this, so let me just... All right, and so what's the price today? In other words, the price that we sold it for. And the price of purchase. Purchase price.
$26.34.
Yes. All right. So that's all the input information that we need to start calculating our returns. All right. So what was our initial investment? How are we going to calculate that? Yeah. In other words, the shares, the number of shares that we bought times price per share that we purchased at. Right, so our initial investment was $2,600. Again, I do round a lot throughout this class, just to save a lot of time when rounding off numbers. So I'm not going to be strictly accurate when I'm discussing figures. So our initial investment was $2,600. All right, so now we're going to get some more information. We're going to find our percent return on investment. We're also going to get our pure dollar return and the cumulative return, right? In other words, what our total portfolio grew to over this time period. All right, so return on investment. Right? How much did we sell for? How much did we buy? That's the information that we need here. Can anyone remind me how we put that together?
Return on investments price today plus payout today minus price to buy asset over price to buy asset.
Correct. Oh, I made a mistake in there. Parentheses are important. I have a hard time seeing this computer. It's the smallest font. There we go. Yeah, parentheses are very important. I put the 0 in here just as a placeholder, right? We're assuming no dividends were paid, but this is just to strictly follow along with the formula, right? So if something is equal to 0 and you're adding it in, you can just completely ignore it. So we don't have to have included that dividend payout of 0, but just for the sake of following along with the formula, I included that. I do want to point out when you're working in Excel, it's very important to be mindful of parentheses. Like you saw, I already made a mistake. Thankfully, when you make a mistake, it's usually very readily apparent when you hit enter because you'll likely get just a crazy unexpected number like we did. All right, so just keep an eye on parentheses. It's very important that they're going where they're supposed to be. So in this case, when calculating returns, we have parentheses around basically our cash inflow, the money that we got from our return on investment, the price that we sold for, plus dividend disbursement. Then we finish off with the second bracket around the entire numerator, and that's where I messed up. I first hit enter. I forgot to include that second parenthesis around the F6. Excel is very explicit with how you input information, right? So I know I want a numerator and the denominator, but with Excel you have to explicitly tell it, right? This is where the numerator ends, then we're going to be dividing by anything after this. All right, so just be mindful when you're working in Excel that you got to be careful where you put your information because Excel is going to interpret exactly as you input it. All right, so we get our total return over this time period of 756%. Any questions so far? Yes.
Yeah. So the price today would be $225.69. Okay.
Yeah.
Okay.
And so if any of you noticed, I also had slightly different subscripts in here. So there is technically a few ways that we can represent the time periods. This is just kind of a technicality. You don't need to worry about it too much, but another way that sometimes this is referred to is previous prices will be in PT and future prices are going to be in PT plus 1, and that's how I had it in Excel. That's just a technicality and don't really have to worry about it. For problems that you'll be working on your assignments, it'll explicitly tell you what's going to be your cash inflow, cash outflow, in other words, how much you paid and what you sold for. All right, so we got our return on investment. We can also calculate this following the capital gains dividend yield sort of disbursement, right? So breaking up our problem here, we have capital gains technically, right, again, if we add 0 divided by our initial investment, we arrive at the same answer because it's equal to 0, right? 0 divided by anything is still 0. We arrive at the same answer. All right, now from here, we're going to calculate our dollar return and our cumulative investment, right? So our dollar return now is going to be our return on investment times our initial investment. Right, so our dollar return on this investment is rounded up 20,000. All I did there was take our return on investment multiplied by the initial investment. And now we can get our cumulative dollar return. And we're going to do this in 2 different ways. All right, so we can take our initial investment and multiply it by 1 plus 756%. And this is how we're typically going to be showing growth rates over time. right? So our total portfolio value when we sold this stock is $22,000. All right, so there's several bits of information that we're looking at here. We're looking at our initial investment. This is how much was initially invested in this stock when we made the purchase. We got our percent return over this time period, over these 8 years. Now using this, we can look at our dollar return. So how much our portfolio grew by, and what the end result is in our portfolio value. Right? Because we have our initial investment plus our return on investment, that gets us our cumulative return. Right? And we can show that explicitly with our initial investment plus dollar return equals our cumulative return. So 2 different ways to arrive at the same conclusion, but this is how we're going to be calculating growth rates in this class, because this is going to tie back in when we start looking at more complicated cash flow tables in the future. All right, so whenever we're looking at growth over time, it's our initial investment times 1 plus the growth rate, which is just our initial investment plus our dollar return. Shows the same conclusion either way we go about making the calculation. Any questions? Yes.
On the initial return of investment formula, could you say it out in like standard form?
Sure. It's the number of shares purchased times the price per share. That's what we're looking at here. How much we bought, how much we paid for it. It's the same idea as when you're ordering food. A lot of my examples come from food. I really enjoy food, so that's what I relate to. Right? So if you're going to a restaurant or you're going to a pizza place and ordering some pizza for some family and friends, it's how many pies you got times the price per pie. Same idea when you're buying an asset. Number of shares purchased times price per share, that's your cost to invest or your initial investment. Any other questions? All right, we got a few more examples on this. Again, using some price quotes. So next one's going to be looking at Netflix. Right? So let's say we purchased 1,000 shares of Netflix for $4.27, December 1st, 2008, and we sold our shares for $687 on September 1st, 2004. Again, these are price quotes I got, I think, yesterday, or Friday. I don't remember. It was one of those days. Close enough. All right, so can you guys walk me through now what information we need and where it's going to be going?
Yes. So shares at 1,000. Shares at 1,000, right?
Correct.
Mm-hmm. That one would be 687.
Yes, and can someone else tell me what the PT stands for? In other words, the price that we sold it for. Yes. All right. What else?
And price to buy asset would be $4.27.
Less than a coffee today.
Wow.
Yeah. All right. So how do we get our initial investment?
You multiply your shares by your 427.
Exactly. Buy our cup of coffee. All right. So our initial investment was $4,270. All right. Now, what's our return on investment?
The price today was payout today.
Is there a payout? No. You're right. It is plus the payout, but this company we're assuming there's no dividends paid, so we can just keep it at 0. All right, so we've got our price. What else? Next.
Okay. Cumulative return.
Minus price in future.
Minus the price that we paid, right? Price that we purchased minus price that we paid divided by price that we paid. Or price that we sold, sorry. All right, so now our return on investment, 16,000%. All right, now, what's our dollar return? This is how much our portfolio grew by.
The investment times your percent return.
Yes. All right. So our dollar return on this cup of coffee is $683,000. So our total portfolio now is going to be equal to our initial investment times 1 plus our percent return for $687,000, right on the dot. And so this is, again, just how we calculate returns in general. We have our initial investment, our cash outflow. We have our cash inflow, how much we sold for, plus any potential disbursements, and the quantity purchased. Again, returns being price that you sell for minus price that you paid for, divide all that by the price you paid. Yes?
If we do have a payout, will it tell us explicitly, like when we do a question, there's a payout?
Yes. Yeah. So usually it'll say there was a dividend, there's a coupon, something like that. Or a payment. That's another way to say it. Any other questions? Yes.
Okay, money return is return on investment times initial investment.
Correct.
How'd you get that percentage, the big one right there? Yeah, that one.
This is just following along with our return formula. The price that we sold for minus the price we paid, close parenthesis, right? That's our numerator. Divide all that by the price that we paid.
Thank you.
Yep. Any other questions? All right, we'll get one more example. Now we're looking at Disney. All right, let's say that we purchased 10,000 shares of Disney stock for 7 cents, October 1st, 1962, and sold all the shares for $91.49 on September 1st, 2024. All right, so again, can someone walk me through the steps here for calculating returns?
10,000 shares.
What's the next bit of information?
The price today is $91.49.
Last necessary information?
Price we purchased is 7 cents.
7 cents, yes. All right. We got everything we need. Our initial investment, how do we calculate that?
How many stocks buy? Your price.
$700 initial investment. What's going to be our return on investment?
Price today minus your price you paid,
In other words, what's the price today?
$91.49.
That's the price we paid. And the last step?
Divided by the 7 cents.
Exactly. 130,000%. All right.
You did it one more time.
So the percent return is the price we sold for today minus the price that we paid, close parenthesis, divide all that by the price that you paid. All right, so we've got our percent return. Now our dollar return. How about someone from the back?
Say investment times per percent return.
Yes. So our dollar return is 914,000. At that sort of rate, we barely have to include our initial investment. It's so small relative to the dollar return. All right, but to get our cumulative return, we can add these together, or how we'll be doing this more commonly throughout the course. Take our initial investment, multiply by 1 plus our growth rate, and we get the same answer. So $700 grew to over $900,000 over this. When did it list? 1962, 40, 62 years? Again, these are actual stock quotes. I simplified it by taking away splits and dividends. So these are underrepresenting the actual returns over these time periods. I know Disney and Apple, I think, did both splits and dividends. I think Netflix did neither, so that might be accurate still. But either way, right, this is a reflection of the return on investment for investing in public equities. Right? Time and an appreciable asset, like equity in general, typically result into significant returns over time. And we're going to see an example, I think, later today about investing in the stock market more broadly. But any questions on returns before we keep going? All right, so in general, when we're looking at returns, they're also very closely related to how risky an asset is. All right, later this semester, we're going to look across asset classes and look at the average return on investment for different types of asset classes. And a very common thing about that is riskier asset classes like equity tend to have a significantly higher return on investment over the long run. They are riskier, right? So in the short run, there are days like today where the market drops several percentage points and people start losing their mind. But over the long run, the returns are significantly positive. So that's just an important thing to keep in the back of your mind for now. Tied to that, we have what's called a risk-free return. Right? A lot of financial economic theories kind of revolve around a risk-free asset. Basically, it means it doesn't have any risk. It's just pure time value in an asset. In practice, it's usually short-term U.S. Treasuries. Right? The U.S. Our outstanding debt is very large, but we've not defaulted on our debt. We've always paid our debt on time. As long as that continues being the case, it'll likely be used as a risk-free asset. I've liked to joke in the past, it'd be interesting to see just from an economic standpoint, what would happen if the U.S. defaulted on its debt. Unfortunately, we've gotten pretty close a couple of times over the last few years. Academically, it's interesting. In practice, it'll throw financial markets into some turmoil. Now, the excess return, or the risk premium, is any return on an asset that risky assets earn above the risk-free rate. Right? So in other words, it's the nominal return that we're looking at minus the risk-free rate over that time period. So there is a simple versus compound interest. Simple interest is interest that you only earn on the principal amount. For the most part, whenever we're dealing with rates of returns, we're really dealing with compound interest because in reality, that's the type of interest we usually pay. I only recently learned that simple interest is often applied to federally subsidized student loans, which I did not know. But they still have a way for bringing interest back into the principal. So it's technically a weird combination of simple interest and compound interest, but that's kind of just a weird technicality. Compound interest is really what we're going to be dealing with most of the time. Interest grows on both principal and interest or growth over time. And that's why we see these compounded results, why we can see hundreds of thousands of % growth over long time periods is because of this compound growth. And in general, compound interest is how wealth is going to be built over time. Right? A lot of people think that they need to come up with some brilliant idea that they can sell everybody in the world on. In reality, it's still possible to attain wealth without that. Just passively investing income slowly over time into something like a low-cost, broad-based ETF can build significant amounts of wealth over time. And in general, just assume that interest is compounded. In practice, that's usually the case, and unless explicitly otherwise stated, assume that you're dealing with compounded interest. All right, so just a simple example of, I don't remember if I put this in the Excel book. It's such a small, it's not in here. All right, so just to illustrate the difference, let's say that we have $1,000 earning 5% per year. How much are we going to have after 5 years? All right, so with simple interest, all you're doing is multiplying that 5% times the principal amount, the $1,000, and adding it up. When you have compounded interest, though, you get the $50 in interest the first year, but then you get 5% of $1,050, which adds up to be a little bit more. Right? Then you get and in the third year, you get the $1,000 plus the $50 plus I think it's like $51 times that 5%. You get a little bit more. All right, Right, so over 5 years, we end up with an extra $25 just from compounding interest. And it doesn't sound like much, and it's not. But over time, especially when we're dealing with rates of return larger than 5%, we can see significant differences just from little additions to additional compounding. All right, so for example, this is looking at the S&P 500 from 1950 through this morning. Right, as of this morning, it was about $5,600. And at the start of this time period, it was about $20, right? Just under $19 in September 5th, 1950. All right, and so this is what exponential growth looks like in reality. Right? Not much going on when we zoom out, and then it starts taking off, and we really start seeing that exponential growth on the right-hand side. The interesting thing with exponential growth is if you really zoom in on these smaller time periods, it looks very similar to what we're seeing today. Right? And that's the nature of exponential growth. You really just see it on the right-hand side of the distribution because that's just the nature of that growth. So as we work through examples in this class, we're just going to be using average rates of return, which is going to smooth out this exponential growth a lot. Right? In reality, financial markets can get pretty messy, and we see significant periods of up and down, and we can see time periods of stagnation as well. But right, we still end up seeing this exponential growth over time, given that you look at it for long enough. Right, and so this is the 500 largest public companies listed in the U.S., and over this time period, it experienced a 28,000% growth. Right, so that's within the range of those handful of stocks that we are looking at as an example. All right, so let's look at another way of looking at time value. All right, so time value of money, the general statement about this is $1 today buys less than $1 100 years ago. All right, we've experienced a lot of inflation recently, so that's something that we can acutely see when we go, say, grocery shopping. Right, things in general cost more. That's because over time, the same unit of currency, right? In other words, a single dollar, purchases less. So this is a screenshot from the Bureau of Labor and Statistics from, I believe this was taken in 1920 for the previous roughly 20 years or so. And it's looking at the price of some food, right? So let's say bacon. Right? In 1910, the price, per pound for bacon was 26 cents. Right, so do you think the price of bacon today is more or less than that? More. Yeah. Right, if we just search it up real quick, let's. I misspelled that. Let's see if we still brings us. All right, so 28 cents versus 5.70. Let's see some other brands. We got some going for $12, $7, $9.50. Right, so obviously, the price of bacon has gone up per pound over the last century. Right? And that's something that we tend to see. When you look at longer time periods, it's much easier to see, right, rather than year to year when inflation is usually much lower. But the price of goods changes over time. And time value, that's a tool that we're going to be using a lot in this course, helps us adjust for that timing. Because the value of anything is what we expect to get from it. So when we receive something has a direct effect on the value of what we're receiving. Right? If I tell you I'm going to give you $1 billion, but it's not going to happen for 1,000 years, how much is that worth to you today? Yeah. It's not going to affect you in any way. So in practice, it's worthless. When we start dealing with time value, we can actually find the value of $1 billion today if we receive it in 1,000 years. It's very small, and we can do an example of that probably by next class. But the timing of something occurring matters, right? And the way that we adjust for that is using these tools of time value. In other words, when we receive our money, this is a bird in the hand is worth two in the bush sort of idea. When we receive money, the probability of receiving it matters, right? The promise of payment is not the same as receipt of payment. So that's something that we're going to have to adjust for. So If things are worth more today than they are in the future, we have to adjust when a cash flow occurs in order to have an equivalent basis to judge the value of that cash flow. How much the adjustment is going to be is going to depend on what's called our discount rate. All right, this is basically just what we're going to be using to equate things across time. And as we'll see, year to year, we're not going to see a huge difference. But the further into our future and the larger the discount rate that we're going to be applying, the more of a spread in values we're going to see across time. And this can significantly affect decisions that we make, or at least should affect decisions we make. All right, so explicitly what we're going to be calculating are four things coming out of time value. Yes?
Okay, the definition said $1 today buys less than $1 100 years ago. But isn't it like that every day the value changes? Is there an average amount of time that you use to calculate how much the value is changing?
Yeah, so that's a good point. The shorter the time period between when we're making this decision, the less it matters. Right? So usually we're talking about years. And in practice, that's what we're going to be doing. We're going to be using years at a time. Right? So discounting between a decision that you make tomorrow and today, in effect, doesn't matter all that much. Right? But the difference between a cash flow received today and promised a year in the future, right? There's going to be a difference there. 10 years in the future, even more so. And there's basically an exponential effect inverse to what we saw with the growth of the S&P 500 that will be affecting our decision. So the smaller the time period between cash flows and decision, the less it matters. Any other questions? All right, so taking this idea, there's four things that we are going to be looking at. Present values, which is the current value of future cash flows. A really nice thing with our field is we often don't have very creative names. And so the names we're talking about here are also definitions, right? So present value, what something is worth today. Future value, what something is worth in the future. Right? So in practice, what this means is when we're dealing with the present value, what we're really trying to do is figure out what is something worth today and are we willing to pay for it? This is very often employed in valuing companies and making investment decisions. Right? So for example, if someone is actively managing a portfolio, part of the process of evaluating what assets they're going to be investing is applying present value principles to figure out how much the asset is expected to be worth today and comparing that to the price that the asset is actually asking for in financial markets. Right? Because there is a difference between the price that you're paying and the value that you're getting. And in no field is that more obvious than what we're dealing with here. Future value is the flip side of that, where we have money that we either have today or will be saving up, expected in the future, and we're estimating what it's going to be worth in the future. Typically, it's going to be used for something like retirement planning. And these are going to be the two most important things that we're solving with time value. The number of periods and required return. There's going to be some other methods for getting that. The number of periods is basically just the time between our cash inflow and our cash outflow. And the required return is the return that's needed for the present value to equal the future value over a given time period. All right, so we need to have 3 out of 4 of these inputs in order to solve for the fourth. Like I mentioned, we're usually just interested in present and future value because number of periods is either assumed or known. Right? If we're dealing with something like the bond market, bond issues tell you how long those bonds are going to be outstanding until maturity. So you know N ahead of time. When you're dealing with something like the equity market, you either use a 5 or 10-year forecast or a terminal value over that time period. So there's a typical assumption that goes into it. Similar with the required return, we're basically going to be ending this class with this entire semester with talking about how we can estimate that. But there are other methods that we use for estimating the required return. So in general, we're really concerned with present and future values within the time value framework. All right, so money today is worth more than money in the future, and that's in general, on average, right? We're dealing with a growing economy. We do see deflation. Typically, that's with economic decline rather than economic growth. That is something that is observed, but on average, for most countries, most of the time, inflation is what we are dealing with. So what we have to do to adjust for that is to discount future cash flows in order to estimate what they're worth today. Right? In other words, how much should we be willing to pay for an asset today? The way that we do that is through the present value formula. So the present value formula, what this is saying is that our value today is equal to our expected future value divided by our discount factor. In other words, 1 plus our discount rate raised to the time between our present value and our future value. All right, so this present value formula is something that's going to be coming up a lot in this class. We're basically going to be using it throughout this entire semester. So we're going to be doing a lot of examples here shortly and for the next few classes. All right, so again, present value is the future cash flow we expect to receive, discounted, at our discount rate raised to the number of years between today and when we receive that future cash flow. When we're looking at future value, we're just rearranging this formula, right? Basically multiplying through by the denominator there. If we're interested in what the future value of a cash flow is, that's going to be how much money we have saved up today, times 1 plus our compounding rate now, and again, the number of years until we'll be receiving that cash outflow. Solving for everything else is, again, just rearranging that formula. If we want to solve for n, it's going to be the natural log of future value divided by present value, divided by the natural log of 1 plus the rate of return. Again, and we're going to be doing some examples on this. Excel is going to make it a lot easier than memorizing these formulas. And again, all these PowerPoints are posted on D2L. I've got a list of formula sheets that contains all the formulas, so don't stress about it too much. And if we have to figure out the rate of return, it's going to be the future value divided by present value raised to 1 over the nth power, minus 1. And again, right, these are usually known or assumed using a different format. N is often known or assumed for different asset classes, right? If you're planning your retirement, you're going to usually estimate 30 to 40 years into the future and is known or assumed in a particular way. If you're valuing a bond, again, the bond issue is going to tell you when the bond is maturing, so you have N already known. If you're dealing with equity, typically you forecast 5 years into the future and take a terminal value. Rate of return, again, we have a different formula that we're going to be using to estimate this. So we're not just going to be mechanically calculating it through the time value framework. All right, so those are the formulas. There's also Excel functions. And very often we're going to be using these in Excel because it makes it a lot simpler to calculate the income. All right, so we have, whenever we're dealing with Excel, always start off with the equal sign, and then you start typing in what your function is going to be, and it's going to tell us what input Excel needs in order to make this calculation work. So I'm going to pop back over into Excel. All right, so first example we have here, basically going to show what we're dealing with when we're working on time value. So let's say that we have $1,000 that's going to grow at 10% for 5 years. How much is this investment going to be growing by? All right, so we have our return formula, also how we can calculate our growth rate. All right, so we can do this mechanically, right? We can show every year what this investment is going to be growing by. So we'll take our initial investment times 1 plus our growth rate. So 10% of $1,000, it's $100. So after 1 year, we've got $1,100 now. All right, so if I just copy and paste this, we're going to see something funky is going to happen. Something funky happened. All right. What went on was basically how Excel goes about calculating things. All right, so unless we make some adjustments that I'm going to show you in a second here, what Excel does in its calculations is called a relative reference. All right, so what I'm doing in this cell here is I'm saying we're going to take the cell right behind us and multiply that by 1 plus the cell 2 columns behind. So unless I make any adjustments, that's exactly what this next cell I copied into is doing. It's taking the cell right behind it, multiplying it by 1 plus the cell 2 columns over. All right, so I'm gonna have to make an adjustment here to our formula by what's called fixing a reference. All right, so I hit cell F4, or you can manually type in a $ in front of the column, in front of the row. And that's going to fix our reference now so that when I copy and paste this cell over, it's going to correctly reference the cell behind us times 1 plus the 10% growth rate, which is what we're looking for to get the value of this growing $1,000. So we've got our $1,100 growing at 10%. Now this $1,100 is going to be, again, growing by 10%. So it's growing by $110. And I can just copy and paste this on over. So if I correctly fixed my reference to the percent growth that we're going to be experiencing here, I can just copy and paste this and highlight the cells I want to copy into. Whenever you see those number signs, it just means that the information there is physically too large to be shown in that cell, so just expand the column over. And now I have how much this $1,000 grew by over these 5 years. So we grew 10% in each one of these years, 10 percentage point growth in each year over 5 years. That first year, that's worth $100. The second year, that's worth $110. Here is where the compound growth is starting to set in. The third year, it's worth $121, and then it just keeps on going up from there. All right, so we showed this in each year, but with the time value framework, we have a formula we can use to kind of skip this intermediary step. We can just take our initial investment and find what it grew to at the end of this time period. All right, and that's what we're going to be doing. That's what we're going to be doing here using this time value formula. We're going to take our initial investment, multiply it by 1 plus our growth rate, close parenthesis, raise it to the year that it's in, year 5. It's going to equal $1,600.51. Same thing we got by manually calculating this growth every year. Again, this is just using the time value formula. We take our present value, multiply it by 1 plus our growth rate, close parenthesis, raise to the year that we're compounding through. And we can change this, update this for any year that we want, right? So if we want to figure out what the growth rate is in the third year, we can just put 3 in the numerator. If we want to figure out what it is 100 years from now, we can just put that in the numerator. Right? And as we saw, that's a big jump going from 5 years to 100 years in the future. But that's the effect of compound growth over time. So that's using the formula. There's also the Excel function, right? Like I mentioned in that PowerPoint slide. So we're using the future value formula. And the nice thing with Excel, I know you can't read this. I can barely read it from right here. But what Excel is doing is it's giving us the definition of the function that we're calling here. Right? So this function, the future value function, the definition is returns the future value of an investment based on periodic, constant payments, and a constant interest rate. All right, and that's the information that we have available to us. All right, so once we open up parentheses, now Excel is asking us for the information in this specific order. Right? It needs all the time value inputs. So first, Excel is asking us for a rate. Our rate is 10%. And we use commas with the functions in order to input information. The next bit of information we need is the number of periods, right? In other words, the time we're compounding by, 5 years. We don't have a payment. A payment is a recurring cash flow, right? So we're skipping that. You can either put a 0 in here or just put another comma. Either way, it'll handle it. And lastly, we need our present value. But we're going to see something a little funky happen. We got a negative value. The absolute value is the same. We still got $1,600.10, $1,610. But the sign is wrong. So what's going on here is when we use time value functions, we need to input a negative sign on either cash inflow or cash outflow. So if we just put a negative sign on this present value, it's going to give us what we expect in terms of the sign. All right, so now we have our future value. $1,000 saved up over 5 years at 10% is going to be worth $1,600 in 5 years. Right, and we've got 3 ways for doing this, right? We can manually grow this cash flow out each year. We can use the future value formula, just following along there, or we can use the future value function that's built into Excel or financial calculators. Right. 3 different ways to get to the same answer. Depending on the situation, one or the other is going to be a little more beneficial. Sometimes we're going to need to use cash flow tables. Right? This is particularly the case when we're dealing with unstable cash flows or difference in changes in growth rates. Right? So sometimes it's going to be more valuable to lay it explicitly all out. Sometimes the function is going to be easier. Right? If we have just consistent information, like we do in this example, the function is going to be probably the easiest to use. And lastly, the formula, that's going to be used in conjunction with cash flow tables, and we'll see that again in the future. Usually it's going to be more valuable in more complicated scenarios. So we got our future value. Now we're going to reverse course. Right? So this question is asking us, what's this $1,000 we have today going to be worth in the future? Now we're going to reverse direction and go into the past. Right? So that's what we're dealing with present values. We're taking some future cash flow and figuring out what that's going to be worth today. All right, so using the present value formula, we're going to take our future cash flow, divide it by 1 plus our growth rate, raised to the number of years. That's going to be the total of our discount factor. And we arrived at our initial answer, the $1,000. Again, we can also use the present value function using the rate, number of periods, skipping payment, because this is a single cash flow, close parenthesis, and again, the same answer. All right, so this is really what we're doing when we're applying time value. We're looking across time in order to make a decision. When we're making future value decisions, how much should we be saving up every year if there's a particular level of retirement that we want? If there's a specific financial goal that we have in the future, if we want to go on a really nice vacation in a few years, how much do we need to save up over this time? At what rate of return on investment can we get? Present value decisions are largely about what sort of investment should we make today, right? So in this particular example, let's say that the price to have access to this 10% growth is $1,050. In other words, the price is $1,050 and the benefit is $1,000. Right? So if the value is $1,000 and the price is $1,050, should we make the investment? In other words, the benefit is $1,000 and the cost is $1,050. No. Exactly, right? The cost is greater than the benefit, so we shouldn't make the investment. With Excel, there's a nice little way that we can kind of automate this with an if statement. Right? An if statement basically is just a logical test that gives you an output based on some input. In this case, we're testing, is the price less than the benefit? If so, So using this if statement, we can play around. All right, so what if the price was less than the $1,000? In that case, the cost is less than the benefit, so we should make the investment. Any questions on time value so far? I know this is a lot of information, and we're going to keep going over it and doing different examples and more examples. In my own undergrad, it took me a while. I don't think I mentioned this last class or at any point so far, but I almost failed my first finance class. I went into it very overconfident. I had gotten like over 100 in my previous accounting class, so I thought, I got this. I don't even have to study for this exam. I'm going to nail it, and I got a D. It didn't go. Actually, it may have been worse than that on the first exam. But it's a lot of information to go through, right? And it just basically takes a lot of work on studying and practicing this to get a hang of it over time. It takes a while. This is not an intuitive sort of thing. And it's something that just takes a lot of time to process and work on. So we're going to keep working on examples. I highly recommend after class you work on this as well. There's stuff to practice in D12 I'll show you later. Question?
For assignments, are we able to use the online financial calculator, or do you want to still use Excel only?
You can use whatever you want. You can use whatever you want. We're using Excel in class because this is really what's used in practice. Businesses everywhere use Excel. Financial professionals use Excel. So that's why we're using this as our calculator. But if you have something else that you want to use, you're welcome to use that. Any other questions?
Can you go over the formula for the worth buying? I'm kind of confused because, like, can you not
yes.
just type in you don't want to invest in it?
Yeah. So this is an if statement, right? So it's basically just asking for a logical test. All right. So if a condition is met, then what? All right. So in this case, our logical test is the price, or in other words, the cost, less than the benefit? Right. And the general idea is you only want to pay a cost if the benefit is at least as much as the cost. Right. So like if you want to go get a coffee and they're going to charge you $50, is it worth $50 to you? No, the benefit is significantly less than that. Right? If they were charging you 50 cents, it would be worth getting. Okay. Right? So the break-even decision is somewhere between $50 and 50 cents. This is basically just a way to automate that. Right? So if a particular condition is met, our logical test, then we're going to have some results. Right? So within Excel, specifically, we have our test, our logical test, is the cost less than the benefit? Right? That's what we're testing. If so, we start off with our comma. Right? I don't know if you can see it back there, but Excel is bolding the current input step. Right? So right now it's asking for our test. When I put the comma in, it's giving us the value of true and the value of false. Right? So if I stop here, it's just telling us it's false, right? Yeah. The price is greater than the benefit. So we need to put in the conditions that we want it on this output. So in this case, if the price is less than the benefit, we'll invest. If it's greater than, we won't invest. Close parenthesis, and it's giving us the result based on the test. Right? The cost is greater than the benefit, don't invest. Any other questions?
Yeah. So, learning about finance, but as far as Excel, I don't really know how to really use Excel that well. Is it okay to stop you once you're doing your formulas and be like, can you redo that formula? Okay.
Yeah, absolutely. And the videos are also recorded and posted on D2L, so you can go back. I'll be posting this Excel sheet to D2L after class, so you can go in and see what I'm doing here. But yeah, absolutely. That's what I'm here for.
How do you turn the answer with a red parentheses from possible?
So that's you're asking about up here, right? So if I didn't put this negative sign, we'd be getting a negative value. What's going on is whenever we use a time value function, we need a negative sign on the cash inflow or the cash outflow. It's basically just an unfortunate byproduct of the history of financial calculators. It's completely unnecessary nowadays, but it's just how it is. So what we need to do is, if we just put a negative sign on all the future cash inflows or outflows, can't see where it's going. If we put a negative sign on that, it's going to turn it into a positive output with our function.
We'll have to do that every single time we're calculating the future value.
Technically not every time, but most of the time, yes.
So how would I know?
That's a good question. It just kind of depends on the nature of what you're dealing with. right? So in this case, we have a single future cash flow that's $1,600. So we have just a single future value that we're dealing with. So in a situation where you only have a single future value, basically you can just put it in there. Right? If we're dealing with positive future values, we can't have a negative present value. Right? The lowest the future value can go to is 0, unless there's negative future cash flows. Right? So if you're dealing with all positive values here, then you should know that your present value should be positive as well. It's bounded by 0 if you have positive future cash flows. So that can just be kind of a guide. And I think it's going to be next week we'll talk about when it gets a little trickier with payments. That's going to complicate it a little bit. But in general, just put a negative sign on whatever you're calculating in here, and we'll go over when that's not going to be the case, I think, next week. Anything else? All right, some more time value. Berkshire B shares are trading for about $480 right now. Let's say the analysts expect the price is going to be $600 in 2 years. All right, so we're going to make another investment decision here. We have our price. We have our expected discount rate. No, that's outdated. We have our expected cash flow. We have our price. We have our discount rate. Should we buy the stock? All right. Let's go through this. So we're going to be using the formula. Right? The formula is our future value divided by, open parenthesis, 1 plus our discount rate, close parenthesis, raised to the number of years. All right. So we get our $480 divided by 1 plus our discount rate, raise that to the number of years. Oh, I put the wrong information in there. The future value should be the 600. There we go. We can also calculate this using the present value function. So we put in our rate, the number of periods, the number of years, 2 years. We're skipping the payment for now. And we have the $600 future value. Excel will usually automatically close up parentheses if you get to put it in here, right? Like I just did. But it's good practice just to close parentheses yourselves, especially when we're going to be using formulas later on. It's going to be on you to make sure you correctly close parentheses where they should be. All right, so should we make the investment? All right, again, let's think about it. The price in the market is $480. The expected value, based on its future cash flow, its future stock price in 2 years, and a discount rate of 8%, is $514. So the benefit is $514. The cost is $480. Should we make the investment? Yeah. Right? Benefit greater than the cost, make the investment.
Can you show the TVM function again?
Mm-hmm. All right, so the TVM function, we're finding the present value, right? What something is worth today. So that's going to be equal sign PV. That's going to pull up our present value function. Open parenthesis. Now we have to input the information. All right, we need our rate, our time period, and our future value, those 3 inputs. So our rate is going to be 8%. Number of periods, 2 years. Skipping our payment. Payment is a recurring cash flow. Future value is a single time cash flow. So we're just looking at a single time cash flow of what we can sell for in 2 years. Any other questions? So we'll just keep working on a few more examples before we wrap up today. All right, let's say that we have $10,000 invested in a broad-based market index fund, expected to earn an average of about 10% per year. If we hold on to this account for 40 years, what is it going to be worth? All right, so we're going to use both the formula and the function. And we're also going to look at it over another decade. So can anyone walk me through using the formula for calculating this future value? What's the initial investment here?
$10,000.
Yep. Times,
1 plus your raise,
which is
10%.
Yep.
To the power of 40 years, because that's your.
exactly. So if we have a single $10,000 lump sum, we invest it, earning an average rate of return of 10%. What is that going to be worth over 40 years? Just under $500,000. Can someone else walk me through the time value of money function for calculating this?
Do future value,
Yes. We're going to use our future value function.
and then the rate, which is 10%.
Yep.
Time period, 40 years.
Yep.
And then the 10,000.
Oh, this is where we got to be careful here. Right. The next step is our payment. Right. This isn't a reoccurring $10,000. This is a single lump sum $10,000. Right. So we got to skip that. Computer, did I? All right. So we're going to skip that, and we're going to get our future 10,000. And we'll arrive at the same answer. All right, so another nice thing is you can always double check your work. If you calculate a problem using both of these methods, you should have the same answer. If you don't have the same answer, something went wrong somewhere in either or both of the methods. All right, so let's add another 10 years here. All right, so I know you don't have much to go on at this point, but how much more money do you think is going to be in this account after another 10 years, right? Remember, you're not adding anything to it. This is just pure compound growth. Some guesses. How much more money do you think is going to be in this portfolio?
721,000.
You think it's going to be worth 721,000?
721,000 more.
More. Okay. All right. Any other guesses?
I'm going about 800,000.
800. Okay. We're about to find out. So following our future value formula, we'll get 1 plus our 10%. I can't remember the answer, so I'm actually a little excited. Raised to 50 years.
Got it.
All right, so the spread now. Oh, you calculated it. Oh, all right, that's actually pretty good. Yeah. All right. Yeah. Well done. All right, so now our portfolio value, we haven't added any money, but we're getting an additional $721,000 by another 10 years of investment. Right? If you remember the exponential growth we were looking at earlier with the S&P 500, we see a lot of exponential growth later on that we can hold off on a portfolio. Right? So what a lot of people like to recommend to people when they're planning retirement, a lot of people think like, I want to retire at 60, I want to retire at 65. If you add another 5 to 10 years, you're not adding like $10,000 a year in savings. You're potentially adding millions of dollars in additional compounded growth over those last couple of years, because exponential growth, when it really starts taking off, it starts taking off and compounds exponentially in very short time periods towards the end when you're reaching retirement. All right, so that's just something to keep in mind, right? You've got a long time until you start considering retirement, but if you start planning for it now, you're going to benefit your future self a lot by planning appropriately. All right, so adding 5 to 10 years at the end of a career, it's not worth a couple $1,000s. It's often worth several $1 million. And we'll do some more concrete examples of that later on just to show you that. All right, so now we got our future value. All right, so we'll get our rate, number of periods, again, skipping the payment because we just have a one-time cash flow. And, oh, wait, nope, I hit the wrong time period. There we go. All right, see, I messed up. I got a different answer, got me to go back and figure out what I messed up. It's very easy. Even if you've been doing this for a very long time, there's so many steps all the time, it's very easy to make a misstep when you're calculating, right? You're going to mess up. You're in school. That's what it's about. But understanding the different routes that you can get your answers can help avoid following through with those mistakes. All right, so this is what exponential growth looks like in practice, right? An initial $10,000, if you give it another 10 years, it's going to be worth another $721,000. Yeah. Any questions on calculating future value? All right, let's say that we have $12,000 saved up and expect a car to cost $18,000. How long are we going to have to save this money if we can earn, say, 8%? All right, so we're just going to use the time value money function for this. Going through with the formula just gets tiring when you're not used to dealing with logs. All right, so we're going to use the MPER, number, N periods, PEER. We're going to use the MPER function. That's going to ask for the rate. We're not dealing with the payment. We're dealing with a single cash flow, present value, and future value. Now, something's going to happen here. We get an error, right? Why did we get this error? Can anyone remind me what I did wrong? Exactly. I didn't put a negative sign in here. Now, it happens to not matter because we don't have a payment, right? So I could put it on the present value and get 527. I can't see it. Or I can put it on the future value. All right, we get the same answer. Either way, you just need a negative sign on either all the present values or all the future values. Again, it'll get more complicated when we bring in payments in the future, but we'll get to that then. Any questions on the NPER function? Now the rate. What sort of return do you have to earn in order to grow $5,000 to $10,000 in 7 years? All right, again, we're just going to use the time value function. So it'll be the rate function, right? Returns the interest rate per period of a loan or an investment. Need the rate. Again, no payment. What do I have to do with either the present or the future value? Negative. We'll put a negative sign on the present value. We have our future cash flow of $10,000. Right, so we need to earn about 10.5% return in order to double our money within 7 years. Any questions on the rate function? Right, so once you start using the time value functions, it becomes a little bit easier, right? You need 3 out of 4 of the inputs. You either need present value or future value, then you need the rate and the number of periods. Put that all together, and then you can answer some questions like, how much do we need to save up in order to meet this retirement or the savings goal? What rate of return are we going to need over that time period? Stuff like that. All right. We don't need breakfast food right now. Any other questions? All right, so again, attendance is due. I've got to get that submitted. I extended the deadline through 5 o'clock today, so if you want to be counted for attending this class, make sure you get that submitted, and I'll see you all on Thursday.